The artificial intelligence bubble did not run out of money, it found a darker place to hide it. For the last 3 years, investors have watched the same spectacular show: bigger models, bigger data centers, bigger chip orders, bigger market values. Every quarter, the numbers became so enormous that billions began to sound like loose change. But underneath that glowing story, a second financial system has been taking shape. It is built from corporate bonds, long-term leases, special purpose vehicles, private credit funds, power contracts, and promises to buy computing capacity that may not even exist yet. One widely discussed estimate now puts the off-balance sheet commitments of Alphabet, Amazon, Meta, Microsoft, and Oracle at roughly $1.65 trillion. That number is larger than the debt those companies report directly on their balance sheets. And before anyone dismisses this as another dramatic bubble headline, understand the important part: these obligations are not imaginary, and they are not all ordinary debt. Many are future lease payments, purchase commitments, construction agreements, and contracts that begin only when a data center or service comes online. They are disclosed in financial footnotes. They are legal. They are often perfectly rational, and that may be exactly why the risk is so easy to ignore. The most dangerous financial structures do not always begin with fraud. Sometimes they begin with a real asset, a credible customer, a reasonable contract, and thousands of intelligent people all reaching the same optimistic conclusion at the same time. This week gave us a perfect image of the mood. Alphabet returned to the bond market with another enormous offering tied to its record artificial intelligence buildout. The deal reportedly attracted around $115 billion of investor orders. Think about that. The market is not reluctantly lending to the artificial intelligence. Boom, it is fighting for the privilege. Pension funds, insurers, asset managers, banks, and private lenders are all searching for a way to finance the machines that are supposed to define the next economy. That does not prove the boom is safe. It proves the boom still has fuel, and this is where the story starts to feel uncomfortably familiar. In 2008, the crisis did not begin because nobody wanted mortgages. It became dangerous because everybody wanted exposure to them. The risk was sliced into pieces, and the chain connecting the borrower to the final investor became too complicated to see clearly. Today, the assets are not suburban houses. They are data centers, graphics processors, custom chips, cooling systems, fiber networks, and power infrastructure. The borrowers are not only families with weak credit, some are the richest corporations in history. So no, this is not 2008 all over again. Not yet. But the financial behavior underneath the artificial intelligence boom is beginning to rhyme with it, and the rhyme is getting louder. To see why, go back to the first stage of the boom. At the beginning, the largest technology companies could fund most artificial intelligence spending from their own operating cash flow. Google had advertising money. Microsoft had software subscriptions. Amazon had cloud revenue. Meta had an advertising machine. They could buy chips and build data centers without asking permission from the bond market. Then the scale changed. The industry stopped talking about adding servers and started talking about adding gigawatts. A modern artificial intelligence campus can require the electricity of a city, years of construction, specialized chips, new transmission lines, backup generation, water, cooling, and contracts that stretch far into the future. Amazon now expects annual capital spending of roughly $220 billion, up sharply from about $128 billion the year before. Alphabet has raised its own investment plans repeatedly. Meta has discussed spending that could approach $145 billion. Oracle has pushed so aggressively into artificial intelligence infrastructure that its financing strategy has become part of the story, not a footnote to it. Even these companies generate huge amounts of cash, but huge cash flow is no longer enough to make huge spending feel small. By late July, Alphabet, Amazon, Meta, Microsoft, and Oracle had reportedly raised close to $302 billion through debt and equity markets during the year. Earlier in the boom, technology companies sold a story to stock investors. Now they are also selling duration to bond investors, leases to infrastructure funds, asset-backed loans to banks, and contracted cash flows to private credit managers. Alphabet has gone so far as to sell a bond that does not mature for 100 years. That is not merely financing. It is a statement of faith. Buyers are effectively saying that Google can remain relevant, solvent, and able to pay long after every current executive, engineer, and portfolio manager is gone. Maybe they are right. Alphabet is enormously profitable, owns irreplaceable businesses, and has a balance sheet most corporations could only dream of. But that is not the point. The point is that artificial intelligence investment is transforming the safest technology companies into some of the largest borrowers in global markets. The more money they raise successfully, the easier it becomes for everyone else to believe the cycle can finance itself indefinitely. Now we need to be precise about the phrase hidden debt. The $1.65 trillion figure should not be treated as if 5 companies secretly borrowed that entire amount from banks and forgot to mention it. They did not. Much of it consists of contractual commitments disclosed outside the main balance sheet, future leases that have not begun, purchases tied to unfinished facilities, capacity agreements, construction obligations, and other commitments that become active over time. That distinction matters. A future purchase agreement is not identical to a bond due tomorrow. A lease that begins after a facility opens is not the same as a bank loan already outstanding. Calling every dollar debt can exaggerate the immediate danger, but dismissing every dollar because it sits in a footnote can underestimate the long-term danger. Suppose a technology company signs a 15-year contract to use a massive data center. The building may belong to a separate investment vehicle. The vehicle borrows from banks or private credit funds to buy land, power equipment, and chips. The technology company does not necessarily record the vehicle's entire loan as its own debt. Instead, it records rent or service expenses as the contract begins. On paper, the debt belongs somewhere else. Economically, however, the project exists because a powerful customer promised to keep paying. This is the magic of the special purpose vehicle. It separates the asset, the financing, and sometimes the risk from the parent company. That can be an excellent tool. Project finance built highways, airports, pipelines, power plants, and communication networks long before the current artificial intelligence. Boom! When each project is isolated, lenders can judge its cash flow and companies can expand without placing every dollar directly on their own balance sheets. But separation is not the same as disappearance. If the project works, the structure looks brilliant. The vehicle owns a valuable data center. The lender receives interest. The technology company gets computing capacity without paying the entire construction cost up front. Investors collect a steady return from what appears to be critical infrastructure. If the project fails, everyone starts asking a question they ignored during the boom: who is actually responsible for the loss? Consider the latest generation of chip financing. Apollo and Blackstone helped assemble roughly $35 billion of financing connected to custom Google chips that Anthropic would lease. CoreWeave disclosed an $8.5 billion delayed draw loan facility designed to fund graphics processors and infrastructure needed for a customer contract. These are sophisticated transactions built around real demand, real hardware, and real counterparties. They are not cartoon scams. But look carefully at the economic chain. A lender funds a vehicle. The vehicle buys chips. A cloud company or artificial intelligence lab leases the chips. The lease payments service the debt. The value of the collateral depends on hardware that may become technologically old in only a few years. The entire structure depends on the customer continuing to need the capacity, continuing to generate money, and continuing to honor the contract. In other words, the collateral is physical, but the confidence holding it together is financial. Oracle shows why the market should pay attention. The company announced plans to raise between $45 and $50 billion in gross proceeds during the calendar year through debt and equity. It wants to preserve an investment-grade credit rating while building enough cloud capacity to serve enormous artificial intelligence customers. Credit analysts have already described Oracle's strategy as the most aggressive among the major providers because the build-out is stretching its financial capacity. Oracle may succeed spectacularly. If demand remains strong, its new facilities could generate long-term revenue and transform the company. But the risk is asymmetric. The buildings must be financed. Now the chips must be purchased now. The power must be reserved now. The hoped for profits arrive later. If construction is delayed, if a customer cannot fund its commitments, or if computing prices fall faster than expected, the debt does not politely wait for the story to improve. That is the first major weakness in the artificial intelligence debt machine. The assets and the obligations live on different clocks. Debt is patient only when creditors believe repayment is certain. Chips are not patient at all. A graphics processor begins aging the moment a better one is announced. A data center built for one generation of hardware may need expensive changes for the next. Power equipment lasts for decades, but the economic value of the computing inside the building can change in months. Lenders are therefore financing long-lived structures containing short-lived technology, supported by contracts based on demand forecasts that nobody can verify far into the future. The second weakness is customer concentration. A surprisingly large portion of new infrastructure is being constructed for a small circle of artificial intelligence laboratories and hyperscalers. OpenAI, Anthropic, Google, Microsoft, Amazon, Meta, Oracle, and a handful of cloud specialists appear again and again on both sides of the transactions. They invest in one another, sell capacity to one another, guarantee purchases, lease chips, provide cloud credits, and use those contracts to raise more money. This can create real strategic partnerships. It can also create the illusion of independent demand when the same capital is moving around a very small circle. Imagine that Company A invests in Company B. B agrees to spend part of that money on Company A's cloud. Company A uses the contract to justify a new data center. A financing vehicle borrows against the expected lease payments. The new capacity supports Company B's valuation, allowing it to raise more money. Every step can be legal and commercially sensible. But from far away, it becomes difficult to separate genuine outside revenue from money circulating inside the artificial intelligence ecosystem. The third weakness is refinancing. The Bank for International Settlements has warned that dedicated vehicles and private credit structures can create new channels of financial stress through refinancing pressure, changes in investor appetite, and the activation of guarantees. The Bank of England has also noted that artificial intelligence financing is spreading through leveraged finance, structured products, private credit, securitized data center assets, and special purpose vehicles. That language sounds painfully boring. It is also where crises usually begin. The stock market watches earnings per hair. The credit system watches whether cash arrives on schedule. If an artificial intelligence company misses its growth target, an equity analyst can lower a price target. If a project vehicle misses a payment, lenders may demand more collateral, raise the interest rate, refuse to refinance the loan, or sell the debt. One disappointment becomes a funding problem. A funding problem delays construction. A delay reduces capacity. Reduced capacity hurts revenue. Lower revenue weakens the contract that supported the loan in the first place. That is how a virtuous cycle can become vicious without a single dramatic bankruptcy on day one. So why is Wall Street ignoring it? Because for now, lending to artificial intelligence looks incredibly attractive. Bond investors can earn more than they earn on government debt while lending to companies with massive cash flows and dominant businesses. Private credit funds can structure deals with collateral, covenants, guarantees, and senior claims. Pension funds and insurers need long-term assets. Data centers look like the railroads, power grids, and ports of the digital economy. And every quarter of rising cloud revenue appears to confirm that demand is real. Alphabet receiving roughly $115 billion of orders for a major bond sale is the market's answer in its purest form. Investors are not blind to the spending. They have decided that the borrowers are strong enough, the assets are important enough, and the artificial intelligence future is profitable enough to justify it. The danger is not that every lender is foolish. The danger is that smart lenders can all be right about the borrower and still be wrong about the price, the collateral, or the cycle. The American housing market did not need every mortgage to fail in 2008. It needed losses to exceed the tiny cushions built into structures that were believed to be safe. The telecommunications collapse did not make fiber optic cable useless. It revealed that too much capacity had been financed too quickly at unrealistic prices. After the dot-com crash, the internet survived and transformed the world. Many of the companies and investors who financed it did not. Artificial intelligence can change everything and still destroy enormous amounts of capital along the way. Technology being revolutionary does not guarantee that every data center earns an adequate return. Demand can grow while prices fall. Usage can explode while profit margins disappear. Better models can require more computing, or they can become so efficient that yesterday's capacity assumptions suddenly look absurd. That is the scenario almost nobody knows how to model. What happens if artificial intelligence adoption accelerates, but the cost of inference collapses faster than revenue grows? What happens if open source models make premium services harder to sell? What happens if companies learn to do the same work with fewer chips? What happens if a laboratory with enormous compute commitments cannot raise its next round on favorable terms? The technology may win while the financing loses. And if that happens, the pain will not be evenly distributed. Cash-rich platforms with diversified revenue can slow construction, renegotiate contracts, or absorb losses. Chip suppliers and networking companies may suffer a brutal cycle but still own valuable technology. The most exposed players are likely to be highly leveraged infrastructure providers, project vehicles dependent on one customer, lenders holding assets that are difficult to value, and investors who believed a long-term contract removed every form of risk. This is why the next warning may not appear first in the share price of a famous technology company. It may appear in a credit spread. A loan may trade below face value. A data center project may be delayed. A private fund may restrict withdrawals. A borrower may issue equity at an uncomfortable price to protect its rating. A customer may renegotiate a capacity agreement that was once described as unbreakable. If you want to follow the story, stop watching only the revenue headlines. Watch capital spending compared with operating cash flow. Watch free cash flow after construction costs. Watch lease commitments that have not yet started. Watch debt maturities, credit default swap prices, customer concentration, and how much new financing is required just to complete projects already announced. Most importantly, watch the language. When management stops describing investment as an opportunity and starts describing it as a strategic necessity, the economics have changed. A company that invests because the return is attractive can choose to stop. A company that invests because falling behind could destroy its core business no longer has the same freedom. That is the trap at the center of the artificial intelligence arms race. Every major company may believe the spending is excessive, yet none can safely be the first to slow down. So they borrow, lease, partner, guarantee, and move obligations into structures designed to keep the race going. The bubble does not burst when people begin calling it a bubble. It bursts when a promise becomes a payment and the cash is not there. Right now, the cash is still there. Bond buyers are lining up. Private lenders are building larger deals. Technology companies continue to produce enormous profits, and demand for computing remains strong. That is why a sudden collapse tomorrow is not the most likely outcome. But it is also why the structure can grow much larger before it is tested. The $1.65 trillion headline is not proof that 5 technology giants are secretly insolvent. It is a warning that the financial map of the artificial intelligence boom is becoming harder to read. The obligations are scattered across balance sheets, footnotes, leases, project companies, private funds, and contracts between firms that increasingly depend on one another. Wall Street is not ignoring this debt because it cannot see it. Wall Street is ignoring it because, so far, the trade has worked. And that may be the most dangerous signal of all. The question is no longer simply which artificial intelligence model will win or which stock will rise the fastest. The question is who has promised to pay if no winner becomes profitable quickly enough. Because when the artificial intelligence music finally slows down, the first thing investors will discover is that the debt was never truly hidden. It was everywhere.